The sales performance over recent quarters has been entirely unacceptable, to the point of surreal. Okay, that is not some cranky Wall Street analyst talking. That is literally the returning CEO of C3 AI right there in their official SEC filing. Welcome to the EDGAR Brief. Today, we're cracking open C3 AI's dramatic Q4 2026 earnings release, filed June 3rd, 2026, and we're translating it into plain English.
Now, what's so fascinating here is you almost never hear a CEO speak this bluntly in a corporate document. Usually, executives hide behind corporate speak, like macroeconomic headwinds or transitional phases. But returning CEO Thomas M. Siebel, he's pulling absolutely no punches.
All right, let's start with Section 1, Welcome and Business Model. We've got to figure out how this company actually makes its money before we go looking at the wreckage. Quick note up front. We're an independent channel, and we use AI to help summarize these really dense filings. So please verify everything on sec.gov before you make any money decisions. We're not financial advisors. We're just here to translate the accounting jargon.
Okay, so what does C3.ai actually sell? They sell an enterprise AI platform. You can think of it kind of like a central nervous system for massive non-tech companies. Picture a giant manufacturing plant or an oil refinery that wants to use AI to predict when a piece of machinery is going to break. They don't have the in-house tech team to build all that software from scratch, so C3.ai provides that pre-built system, essentially locking these giant companies into long-term contracts to manage their data.
And this chart really brilliantly illustrates their whole business model. For fiscal year 2026, 91% of their $250.3 million in revenue came from recurring subscriptions. Only 9% came from one-off professional services. So basically, C3.ai is a software-as-a-service toll booth. They build the software once, and corporate customers pay a recurring fee every single month just to keep driving on the road. Let's move on to Section 2, the financial scorecard. We need to look at these Q4 results to understand exactly why the CEO called their recent performance surreal. First up is gross margin. This tells us for every dollar of software they sell, how much of that dollar actually sticks around before they have to pay for the sales team, the engineers, or the office rent. In Q4 of last year, it was a pretty healthy 62%. But look at Q4 of this year. It completely plummeted to just 22%. Seeing a software company's gross margin absolutely collapse like that in a single year, that is a massive red flashing light. It just means it's suddenly costing them a lot more money to deliver their core product. And the crucial point here is the staggering gap between what comes in and what goes out. For the full year, they brought in $250.3 million in total revenue, but they spent $575.8 million in operating expenses just to run the business. That is more than double what actually came in the door. Which brings us to free cash flow. Now remember, accounting profit can sometimes be a bit of a fiction, shaped by clever accountants. But free cash flow, that is the real, physical cash left over at the end of the day. For fiscal 2026, C3.ai had negative $192.1 million in free cash flow. That's real cash that actually walked out the door to keep the lights on. Okay, so with cash just flying out the window at that rate, we need to look at Section 3, the moat check. What is the competitive advantage that protects them from getting completely crushed by competitors tomorrow? Well, their main defense is switching costs. Because they offer this end-to-end integration across a company's whole operation, once a massive corporation wires C3.ai into their daily workflow across thousands of machines and employees, it becomes an absolute nightmare to rip it out and move to a competitor. Honestly, it's like trying to change the engine on a commercial airplane while it's in mid-flight. That incredible stickiness is absolutely their biggest competitive advantage. Let's pivot to Section 4, reading between the lines. How is management actually handling this massive operating loss in their own words? Are they pointing fingers or taking responsibility? Tom Siebel isn't bearing the headwinds at all here. He is aggressively owning the poor results and framing this whole situation as a massive, immediate turnaround story. He literally says, game on. He's basically telling Wall Street, look, yes, the house was disorganized, but I'm back. We've got a detailed execution plan, and we are fixing it right now. And the numbers actually back up his execution plan talk. They spent $10.8 million last quarter just on severance and restructuring to clean house. That includes $5.2 million purely on severance and termination benefits. So they are paying real hard cash today to wipe the slate clean for tomorrow. Which brings us to Section 5, red flags and risks. We're going to skip all the boilerplate legal jargon and look at what could actually go wrong based on the pure math in this filing. First, we need to translate a bit of jargon, because stock-based compensation is often the silent killer in these tech earnings reports. This simply means paying your employees in company stock instead of cash. Now, sure, it saves the company's bank account today, but it dilutes the ownership pie for shareholders tomorrow. Basically, every new share they print makes your slice of the pie a tiny bit smaller. And that brings us to this truly staggering number, $263.7 million. That is exactly how much C3.ai paid out in stock-based compensation for the full fiscal year 2026. When you compare those two numbers, it's a huge red flag. They literally handed out more value in company stock to their own employees, that $263.7 million, than they collected in total revenue from all of their customers combined. That level of dilution is just incredibly expensive for everyday shareholders. But here is the good news. And honestly, this is why the lights won't just go out tomorrow despite all that burning cash. They're sitting on a massive cash cushion of $673 million, which was actually heavily bolstered by the CEO personally buying 6.17 million shares. Having that kind of money in the bank buys them a really significant runway to execute this turnaround. Even with their high burn rate, that deep pool of liquidity is a major shock absorber for the business while they restructure. All right, let's wrap this all up with Section 6, the bottom line. Let's get our final verdict on C3.ai and look at what you should take away from this explainer. So what is the bottom line? Ultimately, C3.ai is an enterprise software platform with the main strength of a huge cash safety net and really high switching costs. But the main thing to watch is their completely unsustainable operating expenses and that heavy stock dilution. This is a classic turnaround story, plain and simple. So here are the 3 specific things you'll want to track in their next filing to see if Siebel's game-on strategy is actually working out. Number 1. Did they hit their Q1 revenue target of $50 to $54 million? Number 2, is the newly restructured sales team actually landing new contracts? And number 3, has the cash bleeding and stock dilution finally started to slow down? The million-dollar question really is, can C3.ai's new leadership turn their deep pockets into actual cash generation before that runway runs out? And that is your EDGAR brief translation for C3.ai. Remember, this was a translation, not a recommendation. Go read the original filing on sec.gov if this turnaround story piques your interest. Thanks so much for being with us at the EDGAR brief, and we'll see you in the next filing.